all right. Let's get back to business. This market is crazy. Every time we talk about one direction, it decides to go another direction. A few weeks ago, we discussed how we were in an upward momentum and we don't want to predict a reversal, right? We only trade with the trend, not counter trend. Reversal trades are a bit difficult, and I would like us to get to that point down the road, right? Once you've taken a few trades, you've journaled them, and you know what went wrong, what went right, and then you can figure out like successfully, I'm making money, and making money doesn't mean a percentage win rate. To me, it means your wins are much bigger than your losses, so the number of wins versus losses doesn't really matter, right? That's what we need to aim for. We can never be perfect, right? It's 100% win rate. It's just not possible. There are too many institutions who would drive price in one direction or another. The case in point was last Friday when the non-farm payroll came out. It went one way and then decided to go another way, and then it came back the other way, right? So they have a tendency to uh, have the power to manipulate the market. So we don't want to get into the habit of predicting 100% win rates. We just want to get into the habit of uh, consistent wins, right? And that means your account is positive over a period of time. It's possible to have 5 trades in a row that go bad. That's all right. We don't give up just because 5 trades go bad, because that just means we're gonna now look for another uh, system, another strategy. We want to have a strategy that we either prove works or we prove it doesn't work. And 5 trades is not what proves that, right? So it's over a period of time. So we need to be very, very consistent with that. So in the recent market moves, we've seen the market move up. That's I have the daily chart here. Since we've bottomed out at the end of last year, the market has done nothing but go up. However, it has not yet claimed all-time highs. Whether you look at the SPYs, you look at the Qs, IWM. IWM is the worst performer. The diamonds. So none of them have really claimed uh, the all-time high. Diamonds, they're playing around that 78.2% retracement, which is fantastic, right? It's in the Qs, we should be also close to that. From high to low, we're close. We were above it, but we came back down, right? That 78.6. And in the SPYs, we look at the same. This is just for reference, that's why I'm deleting them quickly. We've claimed that 78.6 and going back down. And why is that 78.6 important? As we always talk about, the reversal of a previous strong trend happens at that level, at least based on my experience. There are some people who will trade it slightly different. That's okay. This is what I'm teaching. This is what we're going to stick to. But even with that, the very long term direction is upwards. We had a retracement, and now we're back up after that retracement. And so what we're measuring is that full retracement in that long term uptrend. We're back up to that 78.6% retracement. So now this is where the different things come into play, like supply zone, demand zone, gaps. This is where they all come into the picture. So we said a few weeks ago that price is going to try to go near this supply zone that we have drawn from a long time ago. And if it tests that, it will continue to move up. Or it will drive down slightly and continue to move up, based on our bias that we are short term, still in that long side, right, on the bullish side, that's the position that we are taking. So we did not prepare for any downside plays, which because we are not predicting reversals. Very key. The reversals can happen. We welcome the reversals because that gives us an opportunity to enter, but we are not taking reversals. So that's why I only drew what happens to the upside, right? And so I will erase those because those did not materialize. So what we have seen is after price drove up, now it's starting to make lower highs and lower lows. That's what we are seeing, right? If you were to do a reversal play, this is what you want to see anyway. You want to see a lower high, a lower low before you even decide to do a reversal play, but we're not talking about that. So this is what the market is doing, and it's the same thing in this price, right? It's the same thing. Now, what's interesting here, one of the things that we said, hey, if we close this gap from middle of July, if we close this gap and use it as support, we can go back up. And where did the price reverse in this price? Right at supply zone. Right? It gave you a fake penetration. It collapsed completely that day. It attempted again, it made a lower high and collapsed again. By collapse, I'm talking about the very short term, right? But because we have this gap that we're looking at. So these gaps can be very important. Because now that we have closed this gap, are we going to test this gap as support and continue to head up? Right, that's a possibility right now. So these are all possibilities. And when we go to the lower time frame, it's very easy to see we've closed. We went down demand zone. We went down a gap. Right at the bottom of that gap, I mean, very, very precise, right? These gaps are very good tools to use because they're very accurate, right? And so we went down to that gap and recovered. How far, how long, yet to be seen. So our play really should be about when price is really above, making higher highs and higher lows, and testing this area as support to continue to go up. Why do I say that? Because our pullback is not even at the 23.6%. If you look at, maybe it's easier on the daily to see, if you look at this price movement, every pullback has been extremely shallow. Extremely shallow. We're still having a shallow pullback. Even though people want to panic, if you want to measure, if you want to measure from here to this low, in about 19 trading days, we went down 17 points, right? About 5%. But prior to that, in about 10 trading days, we went down 5%, roughly. So very shallow pullbacks, but they seem huge, right? Because people want to talk about panicking every time something happens in the market. I don't panic when I see this. This is just an opportunity. And so now here we have a gap also. Very critical to remember this gap, because when price is now reclaiming, right? If it decides I don't want to go below 23.6, I'm staying up here. If it's reclaiming, because we're starting to see lower highs, if I take a trade, right? We're not doing any reversal. We're only going in the direction of the main trend, which is up for now. So if I take a trade here, I would like to see that, this is where my first exit is. It's a 1-to-1 ratio, but I'm okay with that, right? And if I want to make it slightly better, and I say, let me take a little bit of a risk, but uh, I'm able to watch the chart very, very closely. I'm not talking about every hour. Like, I see price moving up, and the next hour I have no meeting. I want to just take a lunch break, and I can really monitor it and maybe even look at the 15-minute chart. I will start to push this up. The reason why I say monitor it is I want to be able to exit quickly if price decides it doesn't want to go that way. That I want to be able to make a quick decision. So it gives you a slight better reward. If you push it all the way to the top, it gives you a slight better reward. It's still not a 2-to-1 reward because I would like my stop below the gap area. If I want to go for that full 2, that means I need to make a new high, right? This is why it's risky. Like if you're monitoring it, but this is gonna take time, unless you have a huge gap up day and the first hour of the day 6:30 to 7:30 Pacific time. You want to monitor it, that's fine. But like for my style of trading is for people who work during the day who can only monitor the charts for 2 minutes every hour. So I don't recommend this style. But if you have a little bit of time and you want to push it and just keep moving your stop and be very, very tight on how you make a decision, even if it goes against you by 1 penny, you need to get out with no fear, no greed. You can't say, oh, it's as soon as I get out, it's gonna go back up. That's okay, because my initial exit is down here. My initial exit is down here, and everything above it is gravy. Anything above it is gravy. I'm taking it, and like on a 1-to-1 ratio, more likely than not, I'm 100% out because I have no room to say, hey, let me keep a runner, because if that runner goes against me, then now I lose and I'm back to square one. So I don't want to do that. So I'm more likely out. But if you're monitoring, like you want to keep pushing it, you can. But so that's the position that we're preparing to take, right, on this hourly bar. Spies is very similar. Spies now did not go all the way through and close this gap. So I'm more concerned with the spies. I expect this gap to close before we recover. So if that happens, even if the Qs are leading us, then it's possible that they both come down first. It's a possibility. So we want to be mindful of that. IWM is really lagging in this process. There's this gap here that's closed. This gap is closed, but then this demand zone again is closed. There's other gaps here that is trying to close. So I haven't studied it, and but if you want to analyze it, same process, right? So nothing changes. So be mindful of this gap. Be mindful of this gap. These two gaps are really key for us. Right? We want to make sure we are not trading with headwind. It's okay to have headwind as long as we prepare for it. It's perfectly fine. The spies might give us better entry, better risk reward. Let's go to 1 hour. Are we on the hour? Yes. They might give us better risk reward. I don't know yet. Let's calculate. So yeah, even that gap, right? If we are able to get this gap to close and bounce from there, so somewhere around here as an entry, it's just a guess right now, it might be a slightly better risk reward. So I always say at least trade spies and Qs, right? Don't just do spies, but even if you stick to one, there's enough money to be made. But when you have these two, you have an option to say, hey, which one has a better risk reward? Because the charts are very similar for now. So with that, let's talk about volatility. Volatility right now is weak. Until it spikes, it still tells me we're not in any danger. And you have to see it to really spike. Like if you look at March 23, it went and the whole March this year, it spiked up for a brief moment. And if you compare that to SPY, price, you see how price dips when this spikes, and then when this comes back down, price is going back up. So every time volatility spikes, price is dipping slightly. Sometimes it's more, sometimes it's less, but I just use it as something to just kind of monitor. When we're up here in the red zone, I am preparing and say, hey, could there be a complete reversal now? If we stay here for too long, right? Let's just remove this. So if we look at March or May, when this dip happened, if volatility stays elevated, then are we coming back to test this area? That's what I would be looking at. So that's why, like, once in a while, taking a look at volatility is good. And when volatility stays low, is it possible for price again to reverse and stop going higher? But that's at least that's where it starts, right? Slowly, that's where it starts to die down. Then all of a sudden it pops. But for me, it's when VVX is above 120. At 110, like I draw is warning. Hey, be careful. Reversal possibility. Then look at the rest of the chart. Right? Just because we see this right here, or we see this right here, doesn't mean there's a reversal, right? We have to see a series of lower highs and lower lows, a series of them to confirm, right? So when price has lower high, lower low, slightly higher high, but again, lower high, lower low, lower low, lower low, it keeps going lower, that's when we say, hey, that reversal is taking place. But we don't want to predict, right? We're not in the business of predicting. We're in the business of doing what's right. And that is just follow what the market is doing. I don't like it when it's not straight. There you go. Better. Okay, so now that we've gone over a recap of the market, any trades that you have taken?
Yeah, there was a trade that from last week that we had started to review because I was still in it. And
it was, I believe it was a trade that you took somewhere here.
Yeah.
Somewhere here.
Exactly.
And we were gonna let it see what it's going to do. So did you get out or did you stay?
So I think I had my stop loss lower. I had it right by the demand zone, right there.
Okay.
Kind of like that, similar to that. So a little higher than that maybe. And I exited at when my 2x target was hit on the morning of after that gap up right there on Um,
27th.
Thursday, July 7th. Yeah,
So you're 2x. So you're okay. So you're
kind of like that. Yeah, that's close.
so I
I
want to
kept
get
moving. At first, I had my stop loss much lower,
oh
but
yeah,
then
and then
as
you kept moving. So if you keep
oh,
moving your stop, then
yeah,
you get your two, but that's not really a two, right? For
but
me, the two is from the initial stop.
yeah, I did get a 2 from the initial stop. I just kept moving my trailing stop loss so that it doesn't
Okay.
reverse on. Yeah,
Okay.
so it's kind of just above that the demand zone that you had drawn, like barely above it, just a hair above the demand zone, and then um, yeah, something
Yeah,
like that. Right
something like this. Yeah. Yeah.
there. Yeah,
But
and
that's
then
okay. This is good. At
I
least you got out, right? Did you get out half position, full position?
I got out full position because it's just a huge move. I said, hey, there's likely that there's going to be a pullback. It was almost $10 move there. Actually, it was a $10 move. So I said, let me exit that morning, and then actually that day went all the way back down,
Yeah.
and then tested that same zone that I entered at, and I
Yeah.
said half size. I'm going to enter again before market closed.
So did you
Um,
enter again?
yeah, yeah. Later that day, I actually entered, but only half size because this was more of a speculative. Because
Okay.
I saw that it wasn't like a full hammer. I know it's not as clean as we like it, but it was a small hammer, and it was enough for me to say, hey, I'll just take some small exposure.
Okay.
So
And then what was your exit on that one?
that one was actually right. So my stop loss was tighter than where I had it, but my exit was going to be the same target I had on the last one. So it was more than 2x, but I said that was going to be my target. And then if this doesn't pay out, I'll just cut my loss and move on. And then the next morning, I had another gap up, and then I exited right away when the market opened, which I should have waited a little bit because it went up even more a little bit after the market opened. But I did exit after that huge gap up because I thought there's probably going to be a similar reversal, just like the day before.
So one thing I would like to get out of your vocabulary in trading is should have. The reason is you so when let's do this. Let's do this and we will do it in a 15-minute time frame. Let's actually even do it in a 5-minute time frame. So when this happens, right? Here you go. First 5 minutes of the day. Do you know which way the market is going?
No.
You can guess, right? You can say, look, it gapped up and it will probably go maybe slightly higher. It might not go all the way to previous highs, but it might go slightly higher. But we have seen a lot of days where if it gaps up, it has a tendency to also want to close that gap, right? So you have no idea. So if you get this should have out of your head, the thing that you can focus on is okay, just just pretend that you don't see these
Mm.
right here, okay? Or we can just let's just do this. I think okay, this is where we are, right? This is where we are. I just want to replay it to that moment. Okay. Uh, so let's just pretend this bar isn't on there. When this happens, here's your entry, right? You've entered. You've made 2x, very fantastic. Exiting is not a bad thing, right? The should have vocabulary is out. However, the one thing you can do is, because a reversal could happen, is really make it tight. Like your stop. Move your stop, right? Exit half position. The other half, make it really, really tight. Like you can even make it below this bar. Below the 5-minute bar. Right? If it goes below, I'm out. The other 50%. So if you keep trailing it, that way, right? Bar, bar, bar. So every bar you move it, so you're out here. You get slightly more, because if you move your stop, right? First 5 minutes is here, second 5 minutes is here, third 5 minutes, fifth 5 minute is here, and then this bar takes you out. That's okay, because now our exit is, because we're on the 5-minute bar, it's hard to see. It's 2.76, right? Instead of 2. And that's really, really fine, right? But again, this assumes you woke up at 6:30 because you exited, but this assumes the next hour you're able to monitor, right? You're not rushing to get ready to go to work, right? That's the assumption. If that's not there, then your exit was perfect. There's no should have, because it's a perfect exit, because you don't have time. So there's always the context that you have to put into those trades. And hindsight is your enemy for second guessing your decision, right? So let's not use hindsight, because anytime it could completely reverse on you.
Yeah.
Right? It didn't. It just kept going, and then it reversed at some point, right? Like lunch break, New York, it started to reverse. But then it just kept playing it out. So
Yeah.
we can stop it. And we can go to the 1 hour chart. So here, if exiting here was very good, if you didn't exit here and you kept waiting for somewhere up here, then you can't monitor the trade. You're gone. You come back. That winning trade is now a losing trade. Right? So I think your decision was perfect. And if we should have out of your vocabulary, then we have very good trades. So I'm even excited that you said, hey, I'm going to take this trade second time. Like, I took this trade, was successful, I'm going to take it again. Was successful. Now, the third time, somewhere down here, like this is almost like railroad tracks. You could take this trade. However, where I get concerned now is when I want my 2. This is headwind. That's number 1. Number 2, I'm starting to see lower high, lower low. Do I really want to take a chance here? So close to the gap. I don't want to take this here. Remember I said earlier in the spies, because we didn't close the gap, I don't feel comfortable taking a trade yet. So same thing applies when you have this railroad track. We didn't even close the demand zone completely. No, we only barely touched it. So, and lo and behold, that actually happened. So what exactly I talked about here, future, the past showed us, yes, that's why you don't do that. But you trade so far so good. So far so good. Any other trade?
No, that's it. I've just been really focusing on, not front loading anything, not taking trades that are not fitting my my system. And so
Yeah.
just really focusing on quality trades that if you really wanted to, you could go heavier, right? If you're just reduce the volume, you could say, hey, I'm going to not take, 5 trades a day. I'm going to take 5 trades a week, and then I'm going to wait for my, best setups to happen. And maybe I can go a little heavier than I normally do, maybe like a 2x my normal position side if I really feel that conviction that it's the right play. Otherwise, just stick with your normal size and just take your best trades that you can make. So
Yeah, so there are two things to consider in this. One, if your normal size is based on percentage of your portfolio, no matter how juicy the setup looks, you don't increase your risk. And this is where people lose money because they have successful trades, they have a perfect system in their mind, and they say when this setup happens, have 100% of the time for that particular setup, I'm gonna go all in, right? And then before they know it, half of their account is gone, right? All their winnings plus half of their original amount is gone. So
yeah.
I want you to really have that perspective, right? What is my risk based on my account size? That's the one piece. The other piece is uh, if you want to go heavier, it means you usually don't go heavy. And by heavy, meaning you usually don't go full position. So heavy should be whatever full position means for your risk tolerance. You don't want to go above that, right? So if you usually go half position, and uh, that's you've been thinking about that as a full position for now as you're learning, and you feel like, oh, there's a nice setup, I want to increase my position. You can, because in your long term plan you have the percentage already calculated for what you're willing to risk for your account. Right? If you say the maximum I'm willing to lose on my account is 1%, then your position size has to match that. And so, we can talk about how to calculate that efficiently. But if you're taking 10 positions at 372, 10 shares, and the maximum you're willing to lose is $20. Like, if that's the maximum your account allows, right? For simplicity, I'm talking in small numbers for simplicity. Then full position means 10 shares, and if price drops by $2, I'm out. However, when you have taken this trade here, the loss amount is $3.40. If maximum you can lose is $20, right? If maximum you can lose is $20, I want to bring a calculator here. Right? If maximum you can lose is $20, but you have 3.4, then you can only buy 5 shares, not 10 shares. Right? So that's how you calculate it. Right? And so when you say, okay, full position for me means 10, I usually take 5. I want to go back to full position, it is 10. We're not talking about 20. We're not talking about 15. We're not even talking about 11. We're talking about 10. But when you add a percentage of your portfolio to that conversation, as your portfolio grows, right, once you've increased your account size by, let's say, 10%, then you're able to add 10% to your position size, right? So you can go to 11 now. So as your account grows, that 10 is different, right? It's not the same 10 anymore, right? You have to keep changing. You have to keep playing around with that. You have to keep track of that. If your account goes down, your adjustment has to also happen on that side, right? If 10 was the original position, if account goes down by 10%, now you're buying 8. You're not buying 10 again, because then you accelerate the losses and make it harder to recover. So my recommendation is 1%. Maximum, if you say 1%, is not enough. I want bigger gains. Maximum I say is 2%. Some people who start out with a $2,000 account, 1% doesn't make sense. They're like 50% at a time, right? So that's really dangerous.
Yeah.
And $2,000 is not a trading account, right? You can invest with $2,000 in long term,
Mm.
but $2,000 is not a trading account.
Mm.
Yeah.
Yeah, it definitely makes sense. Yeah, risking 50% on anything is not the smartest idea.
It's a disaster. A disaster. Anyway, so we know what to do. We know what to wait for. Uh, any questions before we wrap up on what to expect or where to go next?
Yeah, there's one thing actually I wanted to ask on spies. I just wanted to go back to it real quick. I think you had said that you expected to close the gap. Is that right?
Yeah.
Before it reverses to the upside?
Yes.
Okay.
That's
So
right.
this drawing would just move a little bit to the right. I think. Is that right? Or I just wanted to make sure I understood.
What do you mean this drawing? This drawing here, the arrows?
Yeah.
Yeah,
Yeah.
the arrows. Yeah, the arrows are just point of reference, right? They're not tied.
Yeah.
So these arrows are not tied to the timeline.
Hmm.
They're just tied to the idea.
Yeah.
So let's so something like this for now,
Mm-hmm.
right? So since we're
Mm-hmm.
here, I would like to see something like this. So always use these arrows as an idea, as a discussion point, and related to the timeline.
Okay.
But good question. Yeah, good question.
Sounds good.
So
Yeah.
yeah, and because I draw it like I'm not expecting like tomorrow morning to we close this gap, right? So this could happen, here like this, or it could happen tomorrow, like this.
Yeah.
BS right now is saying it's possibility that it could be tomorrow, because look, lower highs, lower lows,
Mm.
right? So overnight, if this struggles to make a higher high, it's possible that tomorrow morning we open to close this gap.
Mm.
Right? That's for sure a possibility.
Yeah. Totally.
Yeah.
Would you consider that a gap right there above it closed
This
now
one
because
here?
this
Oh, this
morning
one here.
the gap? Yeah.
This here, yeah, this one is closed, right? Because if you look at this line,
Yeah. Okay. Yeah. Yeah. Definitely.
yeah. For
For
me,
some reason.
I always say if it goes halfway, it's done. It's
Yeah.
closed. It's kind of tricky when
Yeah.
it's on the upside because at some point, since we are U.S. market bullish, at some point it's gonna
Mm.
blow right through it. But I don't even look at it at that time. If it's
Yeah.
closed, it's erased. Right? I don't want to see it
Mm.
because the next time we come back up there, it has nothing to do with that gap.
Mm.
If it's open,
Yeah.
everything has to do with that gap.
Mm.
Yeah.
Yeah. That totally makes sense. For some reason, I was looking at my chart. When I drew it from where it closed green instead of the bottom of the wick because it was
Okay.
green.
Yeah.
But I don't think we should have just drawn it from the bottom of the wick. So with that now that then it is closed.
Yeah.
Okay, sounds good.
All right then. Let's see what happens until we meet next week.
All right. Thanks, Benny.
All right.